In this video, we're going to talk about hedging and how to insure your positions against the losses. Because if you don't like what's happening in the markets right now, with Ethereum going 10% down, Bitcoin going 7% down, there are a couple of things you can do to actually insure you against such losses with basically options. And we're going to talk about options in this video. So you probably know about shorting, how you can short, but options are a little bit different thing that might look scary, but are actually like an insurance you take against certain prices. And in this video, I'm going to explain how it works and how you can insure yourself with options for potential losses. Also, it's a nice option if you expect, for example, high volatility and you want to do and profit from that as well. So Deribit is the largest platform. You have the link down below in the descriptions if you want to start using that with the lower fees. We're going to go through Deribit a little bit, and I'm going to talk to you about what's happening inside. I have already did a couple of tutorials on Deribit in the past, but the last one was like a year ago, and I think a lot of things changed. Plus, they added a couple of nice things, like for example, Option Wizard, which helps you find the best option for your price forecast, which is really great. So I think it's not available in the US currently, but it's available around the world, or you can use VPN, I guess. I mean, yeah, I don't know. You have to read the manual. Also, you have to go through KYC to really use the platform. So I guess VPN is not an option. You have to be outside of the US and outside of the restricted countries. So having said that, let's go to trade, and I'm going to show you how the Deribit looks like inside. So first of all, you have perpetual. So that's the standard thing you can do, and you can go either with standard perpetuals for Bitcoin or for Ethereum. Basically, you can see everything here like you would do on any kind of decentralized exchange, like MEXC or like Hyperliquid. So that's one option. You can trade that normally. But what's really interesting is going with options. And here, the new thing is that you have a date. And that date is important because this is the date where you want to have the price for your particular asset. So, for example, let's say that you expect huge volatility going into the next 2 weeks, and you're going to pick 20th of September, so that's like 2 weeks from now. And basically, this is what's happening. So don't be scared for now. This is not so hard as it looks like. I'm going to help you read what's happening here. So we're trying to predict the price for the 20th of September, right? And this is the strike price, meaning this is the price which with the strike, this is the price that the particular asset will be trading at. We're currently looking at the ETH options. So at the 20th of September. So imagine this scenario. You're already holding a couple of ETH and you want to insure yourself against ETH price going below $2,000 because you think that $2,000 is like such an unmanageable place that you don't even want to go below that, and you will want to secure that everything below 2,000 is fine. It's basically like saying you want to have a stop loss for $2,000, but you're not selling your Ethereum. So let's say you want to do that, right? So you want to secure against $2,000. Now you have puts and calls. Puts and calls are basically for prices above the particular asset. So if you expect things to go above $2,000, you would buy a call, and everything above the particular call, you profit from that. So let's say, and the reverse goes for puts. So if the price goes below $2,000, everything's below $2,000 is the profit for you, and if it's above, it's zero. So you just bought the option. Your price and your stop loss, in a sense, is how much you paid for the option. So that's the maximum you can lose. So this is different than doing shorts, but because with shorts, you don't know exactly how much you can lose, especially if you have large margin and keep adding, you basically can lose everything. In options, you know exactly, at least buying options, because I'm not going to tell you about selling options. Those are a little bit more tricky and have unlimited downside potential. But we're talking simply about buying. With buying options, you only lose what you pay for. Now, this is simple bid and ask. So if you want to buy a particular put, you're going to pay, for example, on the market $28. So what does it mean? It means that if you want to secure one ETH, so if you want to buy one ETH, one put for one ETH at $2,000, you're going to pay $28. Now, what really happens? If the price on 20th of September goes, for example, to 1,800, right? So that's 200 below your option, your strike for your put option, right? You're going to profit from this particular option $200. That's the difference between the strike and the price, right? And this is great for you because you wanted to secure for the price going below 2,000. So if the price is at 1,800 and you bought the put at the strike of 2,000, you're going to profit 200. What was your cost? You paid this $28. So in total, your profit was $200 minus $28. That's exactly $172 or $171.50 in this particular case. So this is your profit. This is the profit with the options. The same would go on with the calls. So let's say you want to actually secure, but the other place you think it will go much higher. And for example, you want to buy something out of the money, meaning that it's currently above the price, because in the money is basically buying something that's already profitable in a sense. So for example, the current price of ETH as I record that is close to 2,300, and say I want to buy again strike, same strike so the price will be at 2,000, but I will buy a call. So what happens there, so first of all, you see that this call is much more expensive. I have to pay $300 for that. And the reason is basically that's the difference with the current price, right? Because this call is right away profitable in the money. The current price is 300. You pay a little premium for the potential volatility, but basically it's in the money. But you expect that actually, this is in a way, you expect that the price will be definitely over 2,000. You don't want to hold along, but you still want to profit of the differences. And you decide that actually buying calls might be the better option because, for example, you will buy calls for 2,000 and you're going to hold them over for the next days. Now, the funny thing is that you don't have to hold them to the finish line. You can sell them before that. This is a more, of course, advanced strategies, but people are doing, funds are doing that. I'm not going to get into that. I want to think about options. I want you to think about the options in the simplest case, which is just the insurance of your position. So you holding spot ETF, spot ETH, and you want to ensure that the price just doesn't go below your expectation, or if you're shorting, the price doesn't go above your expectation. Because, for example, you are in stables, but still you're looking at ETH. You don't want to lose, for example, the chance for that to go parabolic. What's the cheapest option? Actually, the cheapest option will be going with options, because if you expect the price to go over a particular strike point, so if you expect, for example, in the next 2 weeks that the price of ETH will go over $3,000, right? You could buy something super cheap. You could buy actually, you can see those prices here. Those are not really expensive right now. You can buy, for example, strike price of like 2,600 for $25, which means that if your expectation is $3,000, you basically are profiting $400 minus 25, so like $375 per one ETH, and your total cost is 25. So that's like the total profit is like 10x, 15x, I guess. So you can really make 15x on options if you buy a lot of them. The problem is, of course, that you are, if you don't sell them before the expiry date, they're worthless. Because if the price is below that, they're going to zero. So you have to think about that. But again, you can, if you expect that, for example, it's like 19th of September, your expiry date is 20th of September, you think the price won't move that much, you can sell the options for the loss. There's always the market for that. You at least retrieve some of the capital. They won't be worthless. But I think the best way to start with options if you're a beginner is definitely try to just have the simple price, either whether you're bullish or bearish, and try to secure your portfolio. This is basically what I do most of the time. Playing on the downside, I'm trying to have like, for me, this price point of for between 2,000 to 40 is basically something that I want to secure against, and those options are usually cheaper, so you can secure more ETH, and this kind of securitization and it basically is much cheaper than doing with shorts. Also, with shorts, you have to remember about the margin. If you're using a lot of leverage, the because of the volatility in between, the prices can just they can liquidate you entirely. With the option, it's super simple. They can't get liquidated in between. You are secure with the particular asset you bought, so that's really, really cool. So that's the simplest way. Now I wanted to show you also what's new when it comes to Deribit. Let me find the options for what they do. So you can basically, let me go back, let me go with Option Wizard, because they have pretty cool stuff as well. So let's say there are a couple of things here. So they can calculate some of that for you. It's not always perfect, but it will show you something very, very cool. So let's say we want to go with the same example, 20th September, we expect the price to be, say, at $2,000. Right, because we're scared of that, and we want to invest total. So that's the total cost of buying the options. We want to say spend one ETH, so $2,000 for. We can of course do much less, but we want to spend one ETH for everything. And we're going to calculate the strategy, and this is pretty cool because this way the option wizard will show you what you can do. And in this case, it shows you that you can. Because the price is lower, it shows you that you can buy or long put. So you can buy put. Those are the things on the right. For the puts for 2,200, meaning that whatever is below 2,200 and you expect 2,000 or below, you profit from that. And this is pretty much what I showed you. And in this case, so this is the P&L. In this case, you're going to do pretty much like 3x. Right, you're going to get out of your 1 ETH, you're going to get 2 ETH. That's the expected P&L in this case, and the max loss is of course the total of your capital. And you have this nice chart of what will happen in a particular scenarios depending on the price. So that's your expected price, $2,000. But if for some reason it's a little bit below, you can see that what will happen in this case. You also see the break-even price. So if currently the price will be at 2,120, it's still fine. You're going to get break even pretty much. Below that, it's minus, and of course you got zero here. So that's the cool stuff again with options, that you have this. You know exactly how much you will lose, and this is really great. Let's do the other scenario and say same thing, but you expect the price to be at $3,000, right? And you can calculate the strategy here. In this case, Option Wizard should suggest you that you will buy a call. So the thing on the left that I showed you. And this is the case. And it shows you what kind of call you ideally would buy. And the reason for that, buying this ideal call, is that you want to maximize the profit. And it goes basically, it calculates that for you with this particular price. And you can also, in my example before, I showed you that you could buy calls for 2,000 with the strike price of 2,600. This way, you will get even a little bit better on the risk curve, but probably less profit. I think that's what Option Wizard calculates for you. But even in this case, you can see how much you would earn if you would do that scenario and if the price would go up, right? So you actually get 13x return on your capital. You get from 1 ETH, 13 ETH. So that might seem mind-boggling, but this is really, and this is the way how people actually can secure them. So if you're bullish, and especially if you're bullish for 20th of September or 27th, right, this might be it. You can see also like how much you will make. In this case, you will be basically break even at 2,700. So that's really, really great. Now, and with 1 ETH, you could buy actually 172 ETH for 172 ETH call options. So that's really, really great for how you might think about the profit, because you could think about the scenario that, for example, you're not certain about the price, but you think the volatility will be great. It will either go super down or super high up, and you decide to sell some of your ETH. Instead of holding everything spot, you sell some of that ETH and then, or just put it on Deribit, because actually you need to have, you can use margins for both USD and ETH, but you decide you want to have it in ETH. So you put half of your ETH that you have in spot on Deribit and decide that you want to use it for buying options. And for example, you want to have those two scenarios secured with $3,000 and the other being $2,000. So you want to have this kind of a spread between them. There's a particular name for that kind of position, because not only you can have like a time shift with your options, so you can go with 20th of September strike, 27th, 25 October, and so on. But also you can have on the particular chart, you can have both calls and puts, but with different strike price. Even what works is actually, if you go, for example, 27, even what works is actually buying calls and puts for the same for the same strike point. So, and that makes sense. So let me show you what that will do. You expect that will be huge volatility, right? So you want to, for example, you want to find the cheapest options here for both sides. Usually they're around here, around the current price. So I would either buy both puts for 2,200 or and calls for the same price. And what will happen is that you have to see that the price, that's basically $300. And what will happen is that if in the next 3 weeks, because we're looking at September 27th, the price will move by more than $300, you basically profit. And you don't care about the direction because you have both puts and calls. So the one of them will be worthless, but the other part will be will give you most of the profit. And if they move to either 2,500 or on the other hand 190, then basically you're in profit. So those kind of positions are also what people are doing, and there are different stuff that you can really do here. Options are amazing. I think they're a really growing market, especially in crypto right now. In the traditional finance, they're much bigger than the usual, than the standard market. So more people are trading different options or different contracts, futures, than they do with just the underlying stocks. And there's a good reason for that, because you have more options for insuring, hedging your risk, and doing stuff like that. So if you're thinking about shorting for the security, you might as well think about the options. They're not so hard, especially with the option wizard. You can see what are the options. Definitely worth checking them out, because there are different stuff that you can do. But of course, nothing here is financial advice, purely educational content. Options are especially risky, so you have to know what you're doing, and also set aside the capital that you're willing to lose, as is with crypto and anything else. Thank you for watching. Use the link down below in the description, and see you in the next video.